They've drained America long enough. Today, we fight back. President Donald J. Trump Oval Office Statement, April 2nd. In a stunning and unprecedented move during peacetime, President Trump has officially invoked the International Emergency Economic Powers Act, IEPA, and declared a national economic emergency. The first blow, a sweeping 10% tariff on nearly all imported goods, along with special tariffs as high as 46% targeting countries with what he called severe trade imbalances, including Canada, Germany, Japan, and China. This is no longer a trade war. This is full-scale economic mobilization, where every trading partner is now fair game. According to Bloomberg, top White House advisors have described the move as a comprehensive economic warfare plan to reclaim supply chains and defend national security. And an exclusive report by the Wall Street Journal reveals that the Commerce Department has already compiled a list of over 200 strategic product categories that could face immediate tariff hikes if foreign nations fail to change their behavior. The markets responded with chaos. Within hours, the Dow Jones plunged more than 1,100 points, the US dollar surged, and gold prices hit a 14-month high, CNBC reports. This isn't just an economic shock, it's a declaration of war on the entire global free trade system. The backlash is coming, and it won't be pretty. America's closest allies were blindsided. Germany's Minister for Economic Affairs called the move a punch in the face, while Canadian Prime Minister Mark Carney convened an emergency overnight meeting to prepare a full-scale retaliation plan. The result? Stellantis's iconic Windsor assembly plant, which produces hundreds of thousands of Dodge Grand Caravans annually, was forced to shut down indefinitely. A staggering 3,600 workers lost their jobs overnight, triggering a chain reaction across parts suppliers and logistics firms. According to CBC News, the shutdown of this single plant is estimated to cost the Windsor-Essex region more than 220 million Canadian dollars per day. Auto industry analyst Denis Desrosiers told the Financial Post, "If these tariffs last more than a week, we could see a wave of plant closures across Ontario, something we haven't experienced since the Great Depression." More importantly, this isn't just any factory. This plant symbolizes North America's economic interdependence, where auto parts cross the US-Canada border more than 6 times before a finished vehicle rolls off the line. Disrupt that flow, and the entire supply chain begins to crack. The Globe and Mail reports that shares of major Canadian auto suppliers like Magna International, Linamar, and Martin Rea plunged between 8% and 12% in a single trading session following the tariff announcement. Canada cannot stand still while our supply chains are being strangled. Prime Minister Mark Carney. In a swift response to the sweeping U.S. tariffs, Canadian Prime Minister Mark Carney announced a $30 billion retaliatory tariff package on April 3rd, taking aim at American goods, but with a calculated twist. Auto parts were deliberately excluded. According to the Wall Street Journal, the 25% tariffs will target U.S. agricultural products, industrial chemicals, and mechanical equipment, key pillars of American exports to Canada. However, Carney intentionally spared auto components, recognizing the deeply intertwined economic lifeline between Windsor and Detroit that simply can't be severed overnight. Canada is retaliating with an iron fist and a velvet glove, said Gregory Dacko, chief economist at EY Parthenon, in an interview with Bloomberg. This move isn't just political posturing, it's a clear message to the White House. Ottawa still holds key leverage in North American trade. Experts at the Brookings Institution warn that if tensions continue to escalate, these strategic exemptions like auto parts could easily disappear in the next wave of tariffs. When supply chains break down, national pride kicks in, Bloomberg reports. A wave of fierce backlash is erupting across Canada following President Trump's sweeping tariff announcement. From major grocery chains to NHL arenas, Canadian consumers are boycotting American products en masse, a symbolic and economic protest that's spreading fast. Stores are removing American flags, and U.S. national anthems at public events are being booed, painting an unprecedented picture of political and social tension between the two longtime allies. But the most significant blow comes from the energy sector. According to the Wall Street Journal, Canada has swiftly redirected 11.4 million barrels of oil to China and India, markets eager to sign long-term contracts as soon as the U.S. turned up the pressure. This isn't just an economic counterstrike. It's a bold statement. Canada will not be pushed around. This is the moment Canada is showing it's no longer the weaker party in the global energy game, said energy expert Daniel Yergin in an interview with CNBC. The North American energy market is now out of balance. Canada's move has sparked concerns among investors about a potential strategic rift in the oil supply chain, which for decades has been closely tied to U.S. demand. Every time Americans fill up their tanks, they're paying the price for a trade war that's spiraling out of control. CNBC, April 5th. The consequences of the U.S.-Canada trade standoff are hitting home, literally. Gas prices in the United States have surged to $5.25 per gallon, the highest level since 2022. The cause? Nationwide refining capacity has plummeted to just 71%, according to the U.S. Energy Information Administration, EIA, a clear signal of a growing fuel supply crisis. Canada, America's top supplier of crude oil and liquefied natural gas, LNG, has suddenly redirected exports to China and India, locking in multi-billion-dollar long-term deals. Energy flows that once fueled U.S. ports in Texas and Louisiana are now bypassing them entirely, crippling America's strategic supply lines. This isn't just a price shock. It's a full-blown geopolitical energy shock, warned Daniel Pickering, Chief Investment Officer at Pickering Energy Partners, in an interview with Bloomberg. The result? Millions of Americans are now paying hundreds of extra dollars each month just to keep their cars running. And with long-term energy contracts now falling into the hands of Beijing and New Delhi, Washington's dream of energy security is suddenly on shaky ground. Washington fired the first shot. Now Beijing is aiming straight at the heart of the American economy. The Wall Street Journal, April 10th. Global trade tensions have officially exploded as China launches a devastating counterattack, imposing 34% tariffs on U.S. exports, including key products like soybeans, beef, natural gas, and high-tech components. But the retaliation doesn't stop there. Beijing has also issued a sweeping export ban on strategic materials, from rare earth minerals to specialty agricultural products and digital fuels, according to South China Morning Post and confirmed by CNBC. They're shutting off the supply valve. This is a warning shot. America's supply chains are no longer guaranteed, said Derek Scissors, a China expert at the American Enterprise Institute, in an interview with Bloomberg. This blow lands at a particularly vulnerable moment. American farmers are heading into planting season, and factories are already struggling with soaring raw material costs. The ripple effects are expected to stretch from America's heartland to Wall Street, potentially upending the landscape of the upcoming election. If the U.S. controls the dollar, China controls the raw materials the world runs on. Financial Times, April 11th. In a move that sent shockwaves through global markets, China has officially imposed strict export controls on rare earth elements and strategic minerals, including gallium, graphite, and germanium, critical ingredients for producing electric vehicles, semiconductors, and advanced weapons systems. They're not firing bullets, they're hitting the supply chain, said Kevin Book, managing director at Clearview Energy Partners, in an interview with CNBC. It's a quiet attack, but more effective than any tariff war. According to the Wall Street Journal, the decision, announced by China's Ministry of Commerce, came just hours after the U.S. increased tariffs on Asian imports. The move was clearly strategic, targeting the West's industrial weak points. The fallout was immediate. Gallium and graphite prices surged 23% on the London Exchange within 48 hours. Tesla, Lockheed Martin, and Intel all issued warnings about unstable supply chains and rising costs. NATO held an emergency meeting to assess its dependence on Chinese rare earth supplies. We are witnessing a geopolitical reshuffling of the global supply chain, and China is in the driver's seat. Bloomberg Economics, April 12th. The trade war has moved beyond goods. This is now about technology, security, and global control. CNBC, April 13th. In a calculated counterstrike, China's Ministry of Commerce has officially released a list of unreliable entities, targeting several major American corporations, including DuPont, General Electric, and various U.S. defense contractors. At the same time, Beijing has imposed a ban on the export of dual-use items, civilian products that can also be applied to military, high-tech, or aerospace sectors. This isn't just an export ban, it's a message. China will no longer fuel the technological advancement of its geopolitical rivals, said Li Xin, analyst at the China Center for Global Trade Studies, speaking to Bloomberg. The U.S. companies listed now face restricted access to rare earth materials and advanced sensors sourced from China-severed supply chains, particularly in the energy, semiconductor, and industrial machinery sectors, operational challenges for running subsidiaries or conducting R&D within Chinese territory. The market reacted instantly. DuPont shares plunged 8%, while the S&P Defense Sector Index dropped 4.2% in morning trading. China locking down tech exports and directly targeting defense-linked firms marks a major strategic escalation, analyzed the Wall Street Journal, April 13th. A synchronized collapse across trading floors worldwide. The financial earthquake has begun. Bloomberg Markets, April 4th. On April 4th, Wall Street experienced a bloodbath as all major indexes suffered massive losses. The Dow Jones plunged 2,000 points, down 5%. The S&P 500 tumbled 5.7%. The Nasdaq officially entered bear market territory, now down over 20% from its recent peak. The sell-off wasn't limited to equities. Key commodities also crashed. Brent crude oil dropped 6.3%, and copper, a key indicator of industrial health, plunged 8%, hitting an 18-month low. Investors are fleeing risk assets. The mix of escalating tariffs, supply chain disruptions, and global retaliation has created a perfect storm, said Janet Norwood, chief strategist at Morgan Stanley, during CNBC's closing bell. The pain extended far beyond U.S. borders. Japan's Nikkei index fell 3.8%. The UK's FTSE 100 lost 4.1%. The MSCI Global Index dropped 6.2% over just 3 days. We are now witnessing the direct fallout of a global tariff war. This is no longer a theoretical warning. It's a brutal reality, wrote the Wall Street Journal in its April 4th evening report. Europe will not stand by and watch. If Washington starts a trade war, Brussels will be the one to end it. French President Emmanuel Macron, quoted by Euronews, April 5th. A forceful response has arrived from across the Atlantic. The European Union, under the leadership of French President Emmanuel Macron and European Commission President Ursula von der Leyen, has formally proposed a sweeping 50% retaliatory tariff targeting key U.S. exports. According to an exclusive report from Bloomberg Europe, the proposed tariffs would hit American whiskey, large motorcycles, agricultural equipment. The tariff package is now headed to the European Parliament for a vote on April 8th. We're considering targeted, calculated, and clearly deterrent tariff measures. Europe will not be a victim in a crisis we didn't create, von der Leyen told the Financial Times. European markets responded immediately. Germany's DAX index dropped 2.5% shares of American companies listed in Europe. including Harley-Davidson, John Deere, and Brown-Forman, plunged more than 6%. This is a strategic counterstrike. If the EU moves in unison, the US isn't just facing a two-front trade war, it's facing a global one, said Stephen Roach, former chief economist at Morgan Stanley on CNBC Europe. This is no longer a trade dispute. This is a global financial earthquake. Kristalina Georgieva, IMF Managing Director, April 5th, via the Wall Street Journal. The tit-for-tat trade war between economic superpowers has triggered a devastating fallout. $5 trillion in global market value has been erased in just 72 hours. According to data from Bloomberg Terminal, the MSCI World Index plunged 7.2%, its sharpest drop since the 2020 pandemic. Major indexes like Shanghai Composite, FTSE 100, and Nikkei 225 fell between 4% and 6%. Investor assets are losing value at a pace not seen since 2008. We're seeing a cascading sell-off domino style. If the next wave of retaliation hits, a recession is virtually inevitable, warned Michael Ferroli, chief economist at JP Morgan Chase, in an interview with CNBC. At the same time, the IMF has issued a red alert. Global growth may fall below 2% this year. The risk of recession in G7 economies has surged to 70%. Investment capital is rapidly fleeing emerging markets. Political instability, a crisis of confidence, and an asset price shock are converging into a perfect storm for a global recession, said Mohamed El Arian, chief economic advisor at Allianz, on Bloomberg Surveillance. Stock exchanges in New York, Frankfurt, and Tokyo have all entered full-blown panic sell mode as retail investors begin fleeing equities in favor of gold and cash. Canada is playing its energy card, and U.S. refineries are getting nervous. This is a retaliation that can't be ignored. The Globe and Mail, April 7th. Following record-high U.S. tariffs on Canadian goods, Ontario has decided to strike back using its most powerful weapon, energy. Canadian electricity exports account for 20% of total energy demand in the U.S. Northeast. And now, Ontario is considering a 25% surcharge on all electricity shipments to the United States. This hits at the heart of key American industries. Any sector that relies on energy, from manufacturing and food processing to high-tech, will feel this impact, said David McCollum, energy expert at the Harvard Kennedy School, in an interview with Bloomberg. The move not only puts pressure on U.S. refineries already strained by soaring raw material prices, but could also worsen energy shortages in certain regions, as power plants and industrial facilities scramble for alternatives. Ontario kung janjuara, tin hiu man me bang kash je doangung shuat kao jien huan tuan neo hua ki tiep tuk chin sach, tuekwan va hong ko bien pap giai kuyet kach van je tuong mai ton jong. Chin pu Canada gio jai jan su dung angan nang luong hu mot john by chin tri, vua bao venen kinte noi gia, vua gia tung suk ep len hoa kai. Following record-high U.S. tariffs on Canadian goods, Ontario has decided to strike back using its most powerful weapon, energy. Canadian electricity exports account for 20% of total energy demand in the U.S. Northeast, and now, Ontario is considering a 25% surcharge on all electricity shipments to the United States. This hits at the heart of key American industries. Any sector that relies on energy, from manufacturing and food processing to high-tech, will feel this impact, said David McCollum, energy expert at the Harvard Kennedy School, in an interview with Bloomberg. The move not only puts pressure on U.S. refineries already strained by soaring raw material prices, but could also worsen energy shortages in certain regions as power plants and industrial facilities scramble for alternatives. Canada is holding a powerful card. If the U.S. isn't careful, we could be heading toward a much harsher scenario. Bloomberg, April 8th. Canada has clearly had enough of what it views as economic overreach from the United States. In response, the Canadian government is not only tightening its grip on energy exports, but is also re-evaluating critical trade agreements between the two nations. With over 65 terawatt-hours of electricity exports and as a major supplier of crude oil and LNG to the U.S., Canada has the ability to disrupt America's supply chain in a major way. And this is a clear warning. Ottawa may implement new trade restrictions designed to shake up the U.S. economy. Canada is discussing changes to trade terms involving oil and gas, moves that could cause serious instability in the U.S. energy supply chain, reported the Wall Street Journal, April 8. Canada's leverage extends beyond supply. It lies in its long-term contracts. Many of these agreements, particularly with China and India, could edge the U.S. out of strategic global deals. Notably, Bank of Canada Chair Mark Carney emphasized that Canada can easily redirect energy exports to alternative markets, especially in Asia, where demand is rising rapidly. Outlook: a dark future for U.S.-Canada trade relations. In tandem with these bold steps, Canada is actively considering limiting existing trade arrangements with the U.S. and may revise key agreements to better protect national interests. Economists are warning that this escalation could have far-reaching effects, not just for the U.S., but for the global economy, especially if other nations follow suit and begin rethinking their trade strategies. This won't just damage global supply chains, it could redefine the economic structure between North America and the broader international markets. IMF, April 8. This is no longer a trade war. This is full-blown economic retaliation. CNBC, April 8. In a market-shaking move, the Canadian government has announced a second wave of tariffs totaling $125 billion, targeting the core sectors of the U.S. economy: energy, automotive, and industrial metals. Combined with the initial $30 billion tariff package, Canada has now placed duties on a total of $155 billion worth of American goods, an unprecedented figure in the history of U.S.-Canada trade relations. Canada is hitting America where it hurts most: manufacturing, energy, and industrial exports. This is a clear signal that Ottawa won't back down, wrote the Wall Street Journal, April 8th. No longer a warning. This is action. Officials in Ottawa confirmed that the new tariff package will focus on crude oil, liquefied natural gas, LNG, electric vehicles, auto parts, aluminum, and steel, products that are critical to U.S. industry. Prime Minister Mark Carney stated, "We didn't create this crisis, but we won't sit back while Canada's economy and its people are under attack." The move comes amid escalating tensions, triggered by the U.S. imposing tariffs of up to 46% on Canadian imports, sparking a global chain reaction of retaliation. If Washington thinks Canada will play nice forever, they've badly miscalculated. This second wave is just the beginning, said Bloomberg Economics, April 8th. Immediate impact. Wall Street rattled. Major corporations in turmoil. Stocks of General Motors, ExxonMobil, Alcoa, and Ford plunged immediately following the announcement. Investors warn this could be the next big shockwave if the U.S. and Canada fail to find common ground. The market is reacting to a clear fear. The trade war isn't just ongoing, it's accelerating exponentially, said J.P. Morgan, April 8th. We're going through a temporary shakeup. Everything will be fine. President Donald Trump, speaking at the White House, April 8th. While global markets plunge and the U.S. supply chain faces hundreds of billions in losses, President Trump continues to downplay the severity of the economic crisis sparked by escalating tariffs, calling it merely a temporary adjustment period. But economists from Wall Street to Washington strongly disagree. Temporary? There's nothing temporary about dismantling global supply chains and triggering panic across energy markets, said Ellen Zentner, chief economist at Morgan Stanley, in an interview with Bloomberg, April 8th. Hidden fallout, supply chain chaos, and a collapse in confidence. According to CNBC, in the wake of layered tariffs and retaliatory moves from Canada, China, and the EU, thousands of U.S. businesses are grappling with severe disruptions in raw material supply chains, soaring input costs, mass cancellations of international contracts, rapidly declining consumer sentiment. This isn't just economic damage, it's a collapse in confidence, and once trust is lost, it's incredibly difficult to rebuild, warned Neil Irwin, The New York Times. Behind the numbers lies a deepening crisis of confidence. Experts at JP Morgan argue the impact of current tariff policies could drag on for multiple quarters or even years, without a significant shift in the White House's trade strategy. We're witnessing the unraveling of global trade order. If left unchecked, this won't just lead to a recession, it'll trigger an economic restructuring, said Michael Feroli, chief U.S. economist at JP Morgan. Strong words, but no clear plan. Despite offering reassurances, President Trump has yet to announce any concrete steps to stabilize the economy, leaving investors rattled and further shaking confidence in the administration's economic leadership. Reassurance isn't enough. We need real action before the damage becomes irreversible, wrote the Wall Street Journal in an April 8th editorial.